If you are somebody that is completely new into the money game and you want to change your mindset within a year or even 6 months, I'll give you a list. And in fact, I will even direct you on how you should read them. Start from the classics. So before I'll tell you how you make money, I want you to understand something first. If you are buying a stock, I want you to understand that what you are buying an actual business, a real business. If you understand this basic, that buying a stock means I'm becoming a part owner of a business, then it will be easier for me to explain how you will make money from that business to you. I was thinking about what to do with my money. I just don't want to be receiving salary and keeping that salary just in my account. So that led me to checking for investment I can do on Twitter, and I saw cryptocurrency. Okay. So I follow some guys in that crypto space and I invested in some coins then. Terrible mistakes because I have no idea how it works. So that was how I started. And even Bitcoin was at an all-time high then. So I started investing in cryptocurrency. I'll give you one example. When I wanted to move to the UK, I was just sleeping in my room and I just say, I think it's time to move. And I went to just collect my passport the following day and book. I was meant to write an IELTS exam to register as a nurse in the UK. And I booked my IELTS for 2 weeks after the day I collected my passport. So that's the kind of impulsive person I am.
Hello, guys. Welcome back to another exciting episode of the podcast Tech and Beyond. Today, I'm joined by someone who you probably know already on the Nigerian Twitter space and also the Nigerian the UK community. He's a nurse and an active investor who is passionate about advocating for financial literacy. He's an active investor in the Nigerian stock market and other international markets. He also shares practical and personal experiences through his social media to empower everyday investors. His post offers actionable tips for navigating the stock market, avoiding pitfalls, and making informed decisions, inspiring others to take control of their financial future whilst balancing demanding careers in healthcare. Thank you very much, Uthman, for joining me today.
Thanks for having me.
I know we're going to have a very interesting conversation because looking through your profile, you see a nurse, you see an active investor. These are things that you never get to see together. So how exactly did you get into financial investing as a nurse?
Okay, so my journey to investing, that's quite a story there. Obviously, I trained as a nurse in Nigeria. Before now, let's say before 2021, I wasn't investing in anything at all. But along the way, in 2020, I did a little business while in university then. So I was selling something from the northern parts of Nigeria back in the south. And then when I moved to the UK in 2021, so I was thinking about what to do with my money. I just don't want to be receiving salary and keeping that salary just in my account. So that led me to checking for investment I can do on Twitter and I saw cryptocurrency. Okay. So I follow some guys in that crypto space and I invested in some coins then. Terrible mistakes because I have no idea how it works. So that was how I started. And even Bitcoin was at an all-time high then. So I started investing in cryptocurrency. But as someone that likes to do a little bit of research into anything I'm doing so that I'm not going to make a mistake and lose my money. So I started digging into how cryptocurrency works and I realized that the crypto industry is quite new. And in between those my researches, they are mentioning another asset class that is less risky than cryptocurrency. And when they are comparing, it seems to me at that time that other asset seems more genuine and reliable than cryptocurrency.
Okay.
And that other asset is the stock market. So that led me into researching what the stock market is all about. And that was how the journey began. So I just drift from cryptocurrency into the stock market. Then I saw a lot of materials on YouTube, even books about the stock market more than the crypto I was doing earlier. So I started digging in, read, listen to podcasts, watch YouTube video until I figure it out. That was the beginning of the journey. That was how I started basically.
That's interesting. And that leads me to my next question. Talking about the amount of effort you put into developing yourself, understanding what the market is all about. How did you balance the time between your career in healthcare and wanting to become an investor, having to get all the knowledge you did? How did you balance that time?
So the thing is, if you are doing something and and that thing is interesting to you, you are enjoying it, you basically create time for it. So I'll tell you, in the last 4 years, I don't think a day has passed that I'm not going to watch something in relation to investing or personal finance.
Wow.
So it started, and luckily, I'm in a country that the internet is not a problem. So I just started digging into this thing, go to YouTube, search everything about investing. And the good thing about all of these applications is that the way they program those algorithms, as you watch something, it recommend another thing for you. So
Yeah.
what then happened was that it's like I was graduating. So let's say I was listening to someone now. The algorithm is going to recommend more for me. So what I later realized is that I'm moving from less technical people to more technical as I go along the way. So the more the knowledge is expanding, I'm also expanding myself. So that will lead me to many other things. You are listening to something on investing now, and because in that YouTube channel that you are listening to, they mention something about financial retirement. That one will pop up as well, and that will interest me. I want to watch how this person got to retire at age 40. I want to do that. So the algorithm keep pushing that. Then I just found myself in a situation whereby anytime I'm at home, all I'm watching is something about finance. If I'm going to work, all I'm watching is something about finance. And one good attribute about me is also the fact that I take action immediately. That's the way I'm programmed. I'll give you one example. When I wanted to move to the UK, I was just sleeping in my room, and I just say, I think it's time to move. And I went to just collect my passport the following day and book. I was meant to write an IELTS exam to register as a nurse in the UK, and I booked my IELTS for 2 weeks after the day I collected my passport. So that's the kind of impulsive person I am. Once I start to do something, I just make decision. Immediately I started reading about the stocks. I didn't waste any time to download platforms that I can use to put in my money so that I can learn how it really works. So that was how I just found myself in that hole, and I kept digging and I kept digging. And the more I dig, the more it compounds in me. I just find myself like this knowledge is just going, and I just enjoy it. Let's call it like that. If you enjoy something, you create time for it.
Absolutely. I love that you mentioned bias for action. So you talked about taking action. I think that reminds me of one of the core leadership principle at Amazon where they say bias for action. So that means taking action when the moment you think of something, a good idea is something you think you can do. Maybe you the moment you think about it, just take the action immediately, and you have that momentum at that time, which I think is a very good quality. Thanks for touching on that. So bringing me to my next question. Whilst we were growing up, we always assumed investing in the stock market was something exclusively to the elite and the rich people. So I didn't know about the stock market growing up because when you listen to the news at night, you see where they talked about the Nigerian stock market went up by this number of points, something billion, something billion. That was what we would always hear growing up back in Nigeria. And now especially looking at some of the polls, some of the content reports outside, it's almost as if anyone, irrespective of their class in terms of financial income or financial status, can be a participant in this wealth creation mechanism. I want you to talk about what barriers of entry are there to getting into stock investing into this market. Are there limitations for everyday persons like me and you? Or what exactly would you need to get involved in this market?
So I totally agree with what you said. Growing up, I also don't have idea how the stock market works, but knowing what I know now, everyone can partake in the stock market. The stock market has one of the lowest barrier of entry, depending on where you are. If you are in Nigeria, you can start with £1,000, 1,000 naira. If you are in the UK, you are in the US, you can start with even $1 or £1. The barrier of entry is that low. Obviously, it's a different conversation on how much you are going to make in the stock market, depending on what you put in. But to start investing in the stock market, everyone can be involved. And when you talk about how to get into the stock market, some years ago, obviously there was to partake in the stock market, you have to go to a man in an office and tell that man, or maybe even your bank, that man is the broker that you have to go to and say, buy me the stock of so company. So it is that man that is going to buy that stock for you, and they will issue you some stock certificate and all. This day and age, stock market investing has never been easier and simpler. On this day and age, everyone uses a phone. All you need to do is just to download an application on your phone, and within 5 minutes, you are going to open the application and you can start investing in different stocks of your choice. Look at it from this perspective. If you have somebody from Nigeria, if you want to invest, all you need is have a phone, download a brokerage account that is registered, licensed by SEC. And on that application, guess what you need to actually have an account? You need a BVN. You need your passport or your NIN. And the other thing you need is just a utility bill just to confirm your address. That's all you need to have a brokerage account in Nigeria. The same thing if you come back to a place like UK or the US. All you need is find an application, sign up into the application, use a valid identity card. The moment you use your valid identity card, link it to your taxation in terms of your insurance number. Then fund your account and you can start investing in the stocks that you want. So this is the only thing that is the limitation we are having now, and what we are lacking is the education aspect of it. Many random people outside there are not even aware that this thing is available. They are not aware that everything they are consuming are in one way or the other listed somewhere, that they can actually make money from those things rather than just using those things. If a random person understands this, then we have bridged that barrier, and they will know that, so this is how these rich people build their wealth. Because you read about some of these billionaires, look at how much they are making in terms of dividend from the stock market. Look at all those things. Now we need to educate an ordinary person so that they can also understand the dynamics of how this thing really works. That if you are buying a stock, it's not gambling. If you're buying a stock, you are buying a business, an actual business. So these are the message that we need to pass to ordinary people. And once they understand and we get more participants in this market, it's better for us. It's a win-win for everyone. The more participants we have, the better the market will be. It's not just in Nigeria, it's worse in Nigeria, but it's the same everywhere. If you come to the UK as well, the statistic is insane as well. The number of people participating in the capital market in the UK as well is very low. I don't have the statistic on top of my head, but the number is so low. Yeah.
Interesting. Thank you very much for that. You mentioned something. Now we've talked about how do you get into market. We now understand access to the market in this present day is mostly to one of these digital applications. You don't have to go to a broker and all of that. Now, the next question the average man, the layman would ask is, so how exactly do I make money in this market? You've told me it's not a gamble. I'm not gambling with my money. How exactly do I make money in the stock market?
Okay. So before I'll tell you how you make money, I want you to understand something first. If you are buying a stock, I want you to understand that what you are buying an actual business, a real business. If you understand this basic, that buying a stock means I'm becoming a part owner of a business, then it will be easier for me to explain how you will make money from that business to you. So you are going to make money from any business you invest in two ways. The first way is through what is called a capital appreciation. Say, for instance, you invest in a company. Let's use company A. So at this point, let's say the company, the valuation of that company, what the company is worth, let's say is 10,000 naira or 10,000 pounds, as the case may be. And at that point, they decided that, okay, after they did all their calculation, they say, okay, the share price of this company A is going to be 10 naira or 10 pounds. You, as an investor, you said, okay, I like company A. I've done my research about company A. I think it's a good company. Fantastic. Okay, you've done all those. You now say, okay, I would like to be a part of this company. The moment you decide that you want to be a part of that company, the next step for you to take is to buy the share of that company. Once you now buy a share of that company, let's say, just for example's sake, you buy one share of that company, which is 10 pounds, right? Or 10 naira. You are now become a part owner of company A. Company A now went further in the next 1 year or 2 years or even 1 month. Maybe they launch something in their business and their company become more valuable. A company that is worth 10,000 naira or 10,000 pounds before is now worth 20,000 pounds. The moment they become more valuable like that, the share price will also go up. Remember, one share is selling for 10 pounds or 10 naira.
Yeah.
That one share might now be selling for 15 naira or 20 naira. The moment the share price, you bought one share for 10 naira before. Now your 10 naira has turned to 15 naira, which means you have made 5 naira on top of the money you put there. That is one way you make money. Obviously, there are other things that can affect the way company value increases. If demands also improve, in buying a particular company. Let's say so many people got aware of this company and they think it's great, and so many people are buying their shares. The stock market is a game of demand and supply. If so many people are buying their shares, the company value will also improve as well, and the share price will go up. The same thing, if so many people believe this company is worth and they are selling it, or something came up, the share price can come down as well. So that's one way you make money in this market. And also, the second way that you make money in the market is through dividends. Some of these companies, when you invest in them, they will pay you something called dividend. A dividend is essentially them telling you that, oh, miss, thank you for owning our shares. This is your own share of the profit that we make. Now, the way they pay the dividend differs depending on the company you invest in. You can invest in some company and they will be paying you every quarter. Some will be just paying you twice a year or some once a year. Some can even be paying you on a monthly basis. And the frequency of, I would say the percentage of dividend also differs. Some will pay you less than 1%. Some will pay you as high as 10%. And some will pay you more than that. So at the end of the day, when you look at it from this angle, you tend to see that your goal of investing will determine which side that you lean towards. And your age also matters. If you are somebody in your 20s and you have a lot of time in front of you, you can take risk. Obviously, you're going to lean towards much growth. Like you can still take some risk. And if you're somebody that is nearing their retirement, you will want more cash flow. Such kind of person will lean towards a dividend paying stocks. So those are ways that you make money in the market. So that is why it's essential that whether investing or any other thing that you want to do, setting a goal and knowing why you are doing it is essential. Because if you set a goal and you know that, okay, I'm doing this thing to achieve retirement at so time, then you will know how to approach the market. So that's how you make money. Yeah.
That was a beautiful explanation, and I think it couldn't go more granular than that. That was a very detailed explanation. Now, my next question would be, now that I know how to get into the stock market, getting the brokers, using the digital services and all, I know how money is made in the stock market. How do I decide what stock to add to my portfolio?
So decision on which stocks to add to your portfolio, it's now a big step to make, because in the stock market, we have the people that are called active participants and we have the people that are called passive participants. If you are somebody that you know that you can take risk, you can research into individual companies, you don't care if your portfolio goes down 50% at one point and goes up 50% at other point. You can follow CEO of company, you can do technical analysis, you can do all those things. Then you can be an active participant in the fact that you can be investing in some individual stocks, buying and selling them. And at the same time, there are passive participants who doesn't have the luxury of doing all this research. They just want to invest for the long term, buy a company and hold it for the long term with little amount of effort and also make money. So it depends on who you are. Now, there are so many ways to go about it, whether you want to be on the active part or on the passive part. The best way to start is to start from what you know. Say some industries that you work in, some things that you consume, and some things that you know. If you start from there, that's one way to identify core things to invest your money in. You can also go further and categorize it by sectors. If you are in anywhere that you are, some of these sectors are present there. Technological sector, agri, transportation, manufacturing, finance. You can categorize it into those sectors. Those will narrow things down for you to actually know what you are looking for. Now, you now know the good thing. The good thing about all this thing is, if you want to be a passive investor, you really don't have to go through all of this stress. There's another way that you can invest without actually investing in individual holdings. That is investing through funds. When we want to invest through funds, there's something called an exchange traded fund. Treat it like a basket of company. And inside that basket, you have so many company, like an amper pack, and you're going to pay a price of one for all. One exchange traded fund can be selling for 1,000 naira, or it can be selling for £100. But inside it, it contains so many things. And this exchange traded fund usually tracks an index. We have, like, if you are in the West, or even people in Nigeria can invest in it. There is like the Benchmark for the market is the S&P 500. That one tracks the largest 500 company in the United States. We say in the United States, but essentially they are the largest company in the world. Most of the companies inside it.
Yeah.
So if you buy that kind of fund, you are putting your money in
Top 500 companies.
500 companies. What can go wrong? If that thing goes to zero, what you and I will be worrying about is not going to be the stock market. It's going to be something else. If you are in Nigeria as well, there are ETF in Nigeria. There are some ETF that track the 30th largest company with market capitalization in Nigeria. You can invest in such. And another way you can invest, if you don't want to go through the route of ETF, is through mutual fund. If you invest through mutual fund, essentially, mutual fund is like we have a group of professionals and they gather money together from you and I, and they invest those money for us. It is those professionals managing your money. So if you think you want professional to manage your money, then you go through the route of mutual fund. Obviously, you are going to pay much in fee in mutual fund than what you are going to pay for ETF. But for someone that is just beginning, the best place to start is to start through funds. It is not as straightforward between Nigeria and the UK or the US. For people in the UK or the US, it is straightforward. They can buy this ETF, they can sell them anytime, but some of the ETF that are present in the Nigerian space are not that liquid, in that you may not be able to sell it whenever you want. So that is why you see more people leaning towards mutual fund and going through the route of ETF back in Nigeria. So I hope that explains that.
No, absolutely it does. Thank you very much for that. Very good explanation again. So I was going to ask the next question, but I think you already answered it in the fact that which of these three type of investment strategies would you advise a new beginner to go into? And I think you made it very clear that going in with the index fund is a much more practical approach. So it doesn't mean they can't go into individual stock as well, right?
No. So I have an approach that I normally tell people. At some point, I did some one-to-one with some people. So what I normally tell them is that if you are just starting, you really don't know much about the market. Now you have learned the basic. Now start with ETF. If you start with ETF, let that ETF be the foundation of your portfolio and build an habit around that by contributing maybe on monthly basis, weekly basis, whatever, however you want. That ETF is now your foundation. If you now wake up one day after you have built an habit of investing consistently, you now woke up one day and say, okay, I'm ready to take in more risk. I like, there are some companies I like. I use their product and I know that these companies are going to be here for a long time. I think I want to own this company. Even though most of this company might be in your ETF, but we know that the percentage that is in ETF is different from owning 100% of a share. And you now decide that, okay, I want to invest in individual stocks as well. Why not? You can invest in individual stocks as long as you understand the risk and you know what to look out for before you pick these individual stocks. So once you understand this thing and you have built an habit, go for it. Buy those individual stocks. But I will always tell people that even if you do that, still be adding to your index fund so that will be the main foundation in your portfolio. So that if any tsunami happen in the market, your portfolio is not going to be wiped out.
Interesting. That's an interesting take. My next question is trying to understand when is a good time to get into the market. So I'll give you a quick scenario. Someone on Twitter scrolling and sees everyone talking about this particular stock called stock A, how it has gone X or 100% in the last 5 days. That is the first time they are writing about the stock and they're like, everyone's making money from this stock. Let me jump on it as well, right? Is that what we call FOMO? So now at that time, the company is at an all-time high. Is that a good time for someone to also jump in when everyone's talking about it because they've made money? It's at the highest it has ever been. You've just learned about that stock. You're like, oh, I've got some spare £1,000 kept somewhere. Is that a good time to also put it in that stock? Or do you have to wait for a particular time, maybe for it to recline a bit? Can you explain a little bit about that concept? How do you know the best time to buy a stock?
Okay. So in order to explain that concept very well, we need to understand the basic. For somebody that just went on Twitter and see a post about a particular stock flying and they want to buy, that is not the right approach. The right approach would be for them to educate themselves about how the stock market works first. Once they understand how the stock market works, then they can now say, okay, there is a stock flying on Twitter. Should I buy it or not? I'll give you, even for somebody that has been investing for a long time, one of the way that you get stocks that you put your money in It's true, some of this news. If I hear that a stock jumped 20% or a stock dropped 20%, that will interest me. But you know the first thing I would do? The first thing I want to know is why did it jump or why did it drop? You need to understand that first. Because you need to know that the fact that a company dropped 20% doesn't mean that they cannot drop another 20%. Or the fact that the company is jumping today doesn't mean it cannot drop today, or it can continue to jump. So I want to ask myself that initial question first. Why are they talking about this company? If I now know why they are talking about this company, that's what's going to tell me whether this is a ride I need to get into now or something I must not even touch. So you need to answer that question first. And that is why I say understanding the market is the first. Now, about whether it's the right time to buy or not. After you have answered that question and you now understand that company, you understand why it's jumping and why everyone is talking about it. Let's now say you've done all your analysis, both fundamentally and technically. You've checked their finances and everything, and you think, good, this company is great, but it is at all-time high now. Do you now think that company will be worth more in the future or not? If I think even at all-time high, this company is still great, I think there is a lot of room for growth, then you can pay a premium. And now, this is where mindset of investing comes in. If you are investing, that tells me that you are investing for a long time, at least 5-10 years. And you have done your analysis and you think this company is not going to be here in 5 to 10 years. It's going to be worth more.
Yeah.
Then there is no right time to enter. You just enter when you see it. And along the way, before the 5 years or 10 years, it's going to be a turbulent ride. That stock is not going to continue flying all the time. It's still going to drop. But now, this will answer your question. No one knows when it's going to drop or when it's going to continue to fly. Because you now don't know that, that is why you get in. You may now not want to get in with full force. You get in slowly. Buy a bit of it at that point. If all those noise stops, the stock market is like a weighing machine. At some point, it's going to be, the balance is not going to be stable. When there is a lot of noise, that balance is going to be like this. It's just going to be on one side. It's going to be going up. But along the way, it finds its balance. When it finds the balance, everything will die down. And that stock will find its right worth. When that stock finds its right worth, and you think, oh, it's come down again, and I still think nothing has changed about this company will continue to grow. Then you continue to drip in more and you buy more like that and you average down. This is what they call dollar cost averaging. As you are doing this, if the company now pick momentum again, you'll be making money at that time. So there's no really, this is the right time that you must buy a stock. You just need to understand that stock first and know whether you are paying a premium or not. And if you're paying a premium, drip in slowly. And if it's something you like, if it drops, you buy more. Yeah.
Interesting. That's a very interesting perspective. Now, taking me to my next question. For a young guy who probably earns around, say, 250K to 300K naira in Nigeria, or the average guy who's just a little bit above the minimum wage in the UK, how do you decide if you should be saving money or you should be investing? Because a lot of time they talk about make sure you have this amount of fund, have some emergency fund, have savings in the bank. What exactly are the determinant factor to know if you're right for investing or you should still be saving your money in a bank?
Well, I think everyone is right for investing, but there are some nuances to it. So first is that you need to figure out your finances first. It all still boils down to the old age thing that we normally hear about, live within your means. If you live within your means and at the end of the month, you have something left behind, or you must make sure that you have something left after everything. That is why some budgeting rules like the 50-30-20 rules comes in. For some people, it will be 70-20-10, which means 70% for your regular expenses, 20% for your savings and investment, and 10% for your wants. You must make sure that that's how you can live within your means. If you have that kind of budget, there's no way you're not going to have something for your savings and investment. So I think that's the area we need to sort of. People will always say something about, I'm earning this low amount and I'm earning this so amount. I still believe that no matter the amount you are living, you still need to cut your coat according to your clothes to make sure that you stay within those kind of budgets. And here is the thing. Let's say at the end of the day, you have looked at your expenses, you've cut what you can cut, you do whatever, and you still can't save anything because of your situation. Firstly, we all have different situations, but you know that you are not living extravagantly. Money is just not left behind. And it is not just about cutting. Sometimes you just need to earn more. So you just need to earn more by probably learning some skills. If you upskill yourself, you can find more job that pays better. Maybe do more extra shift wherever you are working. Just find somewhere to make more money. If you make more money, then that will lead you to having something aside to invest. When you now have something aside to invest, before you double into the market, you now need to set your emergency fund, which the rule of thumb is have 3 to 6 months of your living expenses. Obviously, if your living expenses is £1,000, we are saying you should have at least £3,000 in savings before you
Cash.
start investing. Of course, you cannot have that. And I'm not expecting you to wait because time is really important in investing. So what I'm going to recommend for such person is have at least £500 in a savings because your expenses is 1K anyway. If you have £500 in a savings, start investing. But now here's the gist. When you now start your investment, you now make sure that that £500 you are topping it up as you are investing as well. Say you are investing £100 a month, then I'm expecting you to be dropping like £50 into your 500. So you are growing your emergency fund at the same time your investment, because your target for your emergency fund is to get it to 3K. So that is how people should approach it.
Wow, that's a very interesting one. I know a lot of people would always, like you mentioned, like talk about their situation, and I completely appreciate that we all have different situations where there are people living in conditions where they live hand to mouth. When they say salary comes in, it all goes out. You don't even have extra. But I love the point where you mentioned that it is not all the time that you get to cut some things. There are times where you just need to look for the other side. You need to earn more money actually, which is true. And if you have a full-time job, you can find something small on the side that you do. It's digital world. There are
Exactly.
lots of opportunities you
in
can.
in these days and age, there are so many opportunities out there. You just need to find something and create a skill. Content creation, when I see people sometimes talk about everyone setting ring lights and all, when they get to the UK, when they do this and all, let them. It's a side also for them. People are making banks, creating contents, just posting on Facebook. If you get monetized, you get monetized. Just on TikTok, you get monetized, you get monetized. And doing all of these things will lead you to do some other things as well. You create digital products, you do this, you do that, and something is coming from the side. So in this day and age, I think it's just upscaling and find a way to just earn more is one
So
of the
say,
things. Yeah.
yeah, saying you are a low earner is not really an excuse these days. Really, if you are really serious and you want to get into the stock market. Thank you very much for answering that question. My next one would be trying to understand. Some people, especially for someone who's just starting out, they've recently got a job, they're just trying to build a life, and you're talking to them about investing. The first thing that comes to your mind is, I don't see my money. I can't control what my money is doing. I'm investing in a company. Another person is making that decision for me. There's this fear that comes with that. How do you explain to someone about the kind of the level of risks in the stock market? Is it the same as that of the, say, crypto market, or just putting your money in the bank? In most cases, when you keep your money in the bank, it's almost certain that nothing will do your money, right? Even when the bank is robbed, for example, there's always insurance like NDIC in Nigeria, FSC in the UK. How do you convince someone to say keeping your money in the stock market is better than putting it in the bank, even though you know that for certain your money is not going anywhere in the bank, but you're not really sure of what's happening once you hand over your money to a broker in the stock market?
Okay, here's the thing. So, see, it all still boils down to mindset. Before you start investing, before you start doing all of these things, the first work is on your mindset. We need to reconfigure that mind for that person to start thinking of the way to generate more money and make their money work for them. See, it is one way. The money equation, I call it money equation. The money equation, the one half of it is for you to earn. The other half of it is for you to now make whatever you earn work harder than even yourself. That is the money equation. Now, this is what I want this person to change in their mind, to know that they are earning. But that money they are earning and they are keeping in their bank, it is actually more risky. What's going to happen to it in the market, because inflation eats into it. You now start to go like, Look at the power of 1,000 pounds last year. What 1,000 pounds can buy last year, it cannot buy it today. Another person will be like, oh, that's true. That is inflation for you. If you now don't want inflation to eat into this money, why not invest it into something that is going to beat that inflation? And your 1,000 will be worth a bit more. Then that person will ask you, what's that thing I can invest my money in that is going to beat inflation? Then they start to get curious. But one thing I've learned on this journey, I talk to a lot of new beginners. One thing I've learned is that people really want to see that this thing actually works. So they want to see relatable examples of how this thing works. For some people that are close to me, I just show them my portfolio and I say, this is what I'm talking about. They get it. For some, you just need to recommend some books for them to read and they will get it. Because understanding those difference between asset and liability and changing your mind into how rich people really get it is the most important thing. So once they understand that, then it comes about the risk. Many people lose their money in the stock market and I don't want to lose my money. Then thereby you have to go in deep and say, there is actually level to the risk that you can expose yourself to in the stock market as well. That is when things like if you invest in individual company, when they go bust, you can lose all your money. But you don't have to. You can invest in things like ETF that you buy 500 companies. All 500 will not go to zero at the same time. And you show them those history that this thing is being around for like 100 years. And over that 100 years, this is how it has performed. When you show them those things and they see that these things are real, they will take action. One thing I noticed is that people really want to see that it works. When I posted, I don't post my UK portfolio. I posted the Nigerian stock portfolio that it made one time. It made 100,000, right? Then
Yeah,
it turned to
correct.
200,000. The profit is now more than 300,000. People like to see things like that. When I post it, I will get a lot of messages. I want to do
How did
this.
you do this?
But those are just to show them that it really works. And then we now need to work on their mindset so that they will know that this thing is a long-term thing and it's not a get-rich-quick scheme. Because if they approach it in a way of getting rich quick scheme, their fear is going to come to pass. Because they fear they are going to lose their money. But if they treat it as get rich quick scheme, they are going to lose the money. That brings the issue of the crypto you mentioned in. It's a different conversation entirely because the crypto space is more risky than the stock market. Obviously, it's also newer than the stock market. If someone has not started investing at all, they just want to start. I mean, I started from crypto myself, but
You
will I
started from
recommend
high
it for
risks
someone?
to
Will I
yeah.
recommend it for someone to start from crypto? Definitely not. But when you understand the dynamics of the stock market and you have built a certain knowledge about how it works, then you can direct yourself that, okay, I want other assets as well apart from stocks. And you know the good thing? There is even a way you can get involved in crypto in the stock market without getting into the crypto space itself.
Really, please tell us about that.
I mean, there are so many companies that are deep into crypto that their base value is based in in Bitcoin and all that are in the stock market that you can invest in those companies. And once you get involved in those kind of company, things like MSTR, MicroStrategy, Coinbase. Coinbase is a crypto exchange that people buy and sell, trade, and
Yeah.
do all sorts. That company is a publicly listed company. If you invest in those companies, it's almost directly proportional to Bitcoin move. If Bitcoin goes up, they goes up. If Bitcoin comes down, they comes down.
Okay.
So you can do that in the stock market. But if you now say, okay, I really want to own Bitcoin myself, then you need to now dig further to understand how Bitcoin actually really works. Once you now understand how Bitcoin really works, then you build a conviction, just like you build it in the stock market and change your mind. And like, this digital asset and also, I want to own it. Then you start doing that. But you should know the risk. And you should know that all your potential investment in crypto, unlike stocks, can go to zero. So that's why that mindset is important. So I think that's what I would say on that.
Couple of times during this conversation, you've talked about assets and liability. I know you talked about how important it is also to get the right mindset. Again, I would have two questions buckled in one so that I don't forget them as we converse. Number one is to get that right mindset. I know you talked about personally, you used resources like books and
Mm,
podcasts and all of that. Can you recommend some specifics for new beginners, not for someone who's already for someone who's just thinking of starting, wanting to
mm,
position their mind to that frame of
yeah.
thinking like this is something I can actually do, not to be worried about, oh, I want to keep my money in the bank. Recommend some resources, books, podcasts. And then secondly, I want you to talk a little bit about deciding when something, how do you know when something is an asset for yourself or is a liability? Because sometimes something might be, people spend money, people do a lot of things they don't even know, or you might think you're investing, whereas you're buying a liability. You might think you are buying an asset, or you might think something is a liability, ends up being an asset. I want you to explain that as well after talking about getting yourself in the right mindset, some couple of resources you could use.
Okay. So starting from books and podcasts, if you are somebody that is completely new into the money game and you want to change your mindset within a year or even 6 months, I'll give you a list, and in fact, I will even direct you on how you should read them. Start from the classics. The Richest Man in Babylon should be your first. That is by Classen. The second one should be Think and Grow Rich by Napoleon Hill. The third one should be Rich Dad Poor Dad. Then the next one will be The Psychology of Money. After The Psychology of Money, read I Will Teach You to Be Rich. After you read I Will Teach You to Be Rich, read Atomic Habits. After that one, read The Algebra of Wealth by Scott Galloway. And once you finish all this, by the time you finish all of this and you really read them, you will have gotten this grasp of everything we are saying. If you don't want to dig further, you can read books like Intelligent Investor by Ben Graham. There's a reason why I listed them like that. When you read books like The Richest Man in Babylon, it gives you ways to actually manage your money in terms of like budgets. It tells you save 10%, invest 10% of everything that comes into your account. And it's so simple and concise. It's a very small book that you can even read in 2 days. And it's those kind of book that the way they wrote it is like they're telling you a story. It's a book that when you start, you don't want to leave it. And then you move to Think and Grow Rich. That works on your mindset about positivity and things like that. And then you move to The Rich Dad Poor Dad. That tells you all those different between asset and liability, different between employer, employee, whatever. Then you move to The Psychology of Money. That one is now relating it to real words. Example, how real billionaires actually build their words. This so many things about the psychology of money. And then you go to I Will Teach You to Be Rich, which is also relatable as well, but it basically tells you how to spend your money and how to manage things like credit card and all of those things. And then you move to the other one I mentioned. So it's like a step-by-step guide. If you can follow it, you are going to do well in terms of managing your finances. So in terms of podcast, obviously, I know everyone. I know some of your audience are in Nigeria and the UK and the likes. It's difficult to actually get so many podcasts in Nigeria. There are not so many of them, but there are some I consume. The guys in Nairametrics, they do one podcast, Drinks and Mics. It's a good podcast for everyone that wants to understand finance in Nigeria. There is Venture Valley. It's not really about stocks in particular, but it's about businesses. So they invite entrepreneur and all sorts
Is it
into that
Nigeria as
podcast.
well?
Yeah, it's Nigeria podcast as well. So, but now coming back to the West, there are so many American podcasts. Americans are way ahead of everyone in terms of this topic.
Wealth creation. Yeah.
Yeah, in terms of wealth creation and all, they are way ahead of everyone. So there is the Founders Podcast. They have done more than 400 episodes. Find any inventor or innovator, they have done podcasts about them. Warren Buffett, Charlie Munger, Elon Musk, Jeff Bezos, Mark Zuckerberg, they've done podcasts on them. Go and listen to that one. Founders Podcast. It's on Spotify. The Diary of CEO, that's one of our own in the UK, the biggest in Europe. Listen to him. In fact, there are 2 episodes I would recommend for people in finance. He did one with Ramit Sethi, and he did one with Morgan Housel, who is the author of The Psychology of Money.
Psychology of money.
So those 2 episodes are so good that if you listen to them, it just has a way of transforming your life. There is The School of Greatness by Lewis Howes. He also invites a lot of great people into his podcast. Which other podcasts again? I think that and some of these authors of those books I mentioned, Morgan Housel has a podcast as well. James Clear has a podcast. And Tim
Yeah.
Ferriss, the guy that wrote the 4-Hour Work Week, he has a podcast as well. So some of these guys, they also combine things together. And when you listen to them, and the good thing is, even if the moment you start listening to one or two, YouTube or whatever is going to be pushing others
Algorithm starts recommending for you.
to you. So that's what I would say on that. The last part of the question, it's
Asset
something
and
about asset and
liability.
liabilities.
Yeah.
So the way we determine asset and liability is quite individualistic. But one thing is sure, an asset is something that's going to be much valuable to you in the future. And at the end of the day, it's going to bring in money to you. A liability is essentially something that is going to take money away from you. And at the end of the day, will not bring in anything back to you. That's the simpler explanation. Now, it now depends on what you categorize as assets and what you categorize as liability. When you consider things like stocks, crypto, real estate, most of these things falls into asset category. When you categorize things like liabilities, now there are some nuances to this. And I know if the account guys, if they catch me, they will say things
Yeah.
like
Yeah.
no matter
It's an
what doesn't
asset.
fall as liability, that is an
Yeah.
asset. So in accounting, is an asset. But if you are somebody that is, I'll put a nuance to it. If you are somebody that is, say, you are earning a low income, you can survive without buying a car, and it's not going to affect anything. That it's a want to you at that time, not a need. And you then go and use that money to buy that thing that is going to be getting money outside of you, and you don't even need it at that point, then that will count as liability to me. At the same time, when you say, for some people, they will say, I also have an unpopular opinion here. For some people, they will say buying a house that you be living in counts as liability. I don't agree. That it's only a rental property that counts as investment. I don't agree with that. It's not just everything that we put on spreadsheet. Sometimes when you buy a home to live with your family, what about all those memory created in that house? Those are investment you can't put a number
That you
on.
can't put a number on. Yeah, exactly.
So to me, I would just say what counts as liability to me, it's just you buying something you want and not something you need. The moment you start spending money on wants, things that you don't necessarily need now, and you can use those money to buy genuine assets, then that's what counts as liability to me. Yeah.
Interesting take. I know. Speaking about your unpopular, I've seen a lot of financial guru having different perspective around his house and buying a house to live in. Some people would say, well, it ties you down, it does this. Other people would say, personally, for me, I think I agree with your school of thought. I think for some, again, not even talking about the psychological part of it in terms of, oh, you feel settled there, you feel this, and then this is. It's also appreciating capital as well in the field. So it's another real. It's just like another real estate, like continuously appreciating. So I think for me, it could also stand as an asset. Now, taking me to my next question is around debt, especially for some of us that come from from Nigeria, for example, including yourself. You will know that the concept of debt financing is not something we are very used to because it is not something readily available. Again, this thing might even be readily available, but it's always a thing of the elite, just like the stock market I was talking about. This there might be people doing a lot of mortgage related activities, debt financing, credit card. I didn't know it was available to the common man until I got here. I know credit card existed, but I thought it was only for the top guys. Now moving to a different environment, you realize that the economy is built on debt servicing, debt financing. Like you could pretty much get finances for almost anything you want, right? How do you advise new immigrants, for example, people like myself and yourself, to sort of deal with this big change coming from a society where you pay cash for everything to a society where everything is almost readily available to you? If today you want to drive a Porsche, honestly, probably your credit score and very little deposit that you need, right? So how do you advise people to deal with that transition?
Okay, here's the thing. So the first thing when you come into this country that you realize is that, hey, it's a credit system society. Because essentially the credits is like a short form of credibility. That's what tells everyone that is going to loan you or do anything to you that, okay, this person is a responsible person and they are credible. Now, coming from an environment that you are not used to this and you come into a country that is based on that system, you need to be very careful in that the first thing you should learn about is to learn how those credit system actually works and how to use it to your own advantage. Because there are so many things into this thing. Because the way that people creep into being in debt is because of the availability of these things. You even be get email bombarding you that you are qualified for this credit, you are doing this. Now you are somebody that is coming from a country that you don't have such available, and you are now in somewhere that these things are available and you can get them and you can use it to buy whatever you like. As long as you are paying the minimum back, you are fine. Now, if you don't learn how it works, you are going to use it very wrongly. And at the end of the day, the consequence is not so great. A lot of people have been in debt that they are still paying because of that decisions that they take. Now, how do you understand the credit system? So you want to know that, okay, I need to build my credit score. What are ways do I build my credit score without debt? That's the first thing you should ask yourself. If you ask yourself that, then you find out. Then you find things like registering on electoral roll.
Yeah.
Then you find some other things like paying all your regular bills on time, don't miss out on any direct debit and things like that. Then you move further and you say, okay, there is credit card. How do I use this credit card to my advantage? They don't want you to use the credit card to your advantage. They want you to use it to benefit them. Do you think these big companies offering you credit card are just offering you free money and they're not making anything of it? The thing is, these guys have done so many researches on human psychology, and they know that if they offer you these things, even you can convince yourself that, okay, I'm going to be paying it off without paying the interest. But 70 to 80% of the population will not pay it off to miss out on the interest. Now, yes, people will say there are some credit card with zero interest at all. Yes, people will say, yeah, there is 0% interest rate. Even if you get the credit card, you're not going to pay any interest. How many of the first timer are going to get 0% interest? Most of the credit card you're going to get will have a very high interest rate from 18% and above. So essentially, and they're going to offer you an option. Say they give you a credit limit of £500. They say you can use this £500 and you spend £250 out of the 500.
Yeah.
The credit company will say, this is your statement. You have spent £250. You can pay this statement or you can pay minimum of £12. And if you pay this minimum, it won't affect your credit score. You are still fine. Many people will pay the £12. The moment you pay that £12, every other debt you leave in that account will accumulate interest. And you now tend to see that this thing keep on going up and up. And if you find yourself in that cycle, you find yourself getting another credit card from another company again, and you do the same thing. Then you have debt in this one, crapping up interest. You're having this one, crapping up interest, and you find yourself getting another one. I've seen real story. You know, I talk about finances. People have come to me and they have this debt, and they don't even know how much they are incurring in debt, in interest towards this debt. So now the point I'm trying to make is, if you just come, you need to be careful with some of these things. If you know that you are a disciplined person, credit card is one of the greatest way to build your credit score. Get it, but make sure that you don't spend more than 25% of your credit card every single month, because the utilization is actually what's going to build your score. The moment you start spending more than 25% of your credit limit, then it's going to have negative effect in your credit score. Now, if you use 25% of your credit score of your credit card, make sure that you pay it off every single month. If there comes a month that you know that you are not going to be able to pay, don't spend your credit card. Because what credit card does to your mindset is that
So it's
you
not my
tend
money.
to be buying some things that you can't afford
Yeah.
because you have them in credit. So it requires a lot of discipline. And if you don't have this discipline, stay away from it. If you are worrying about credit score, all this phone subscription that we are doing, they count towards your credit score. Don't worry about it. You don't have to get a credit card to have a good credit score. That's the point I'm trying to make. So when you come to this country where some of these data are available everywhere, anywhere you turn, you can get it. Don't fall into the trap. Because at the end of the day, some of these things will contribute to what is going outside of your account every single month. You just find out that the moment you finish on your direct debit, nothing is left in your account to even invest or save. So people need to be careful with this, yeah, and don't get into the trap.
Thank you for that wonderful explanation. I'm afraid our time is fast running. I think even though we spent 1 hour, because I'm enjoying every bit of this conversation. I want you to quickly talk about something which is the compounding. I often hear a lot of time people talk about the power of compounding. Just in one of the interesting thing about investment is the compounding. Can you explain exactly what this means in very simple terms, and how does one benefit from compounding?
Compounding is a mathematical expression. It's nothing that is strange to the word. So it's a mathematical expression, but the way it works like magic. In fact, Albert Einstein was credited to have said compound interest is the eighth wonder of the world. How does it now work? It's in a simple term. Time is the most important fact in compounding. That is why the earlier you start investing, the better it gets. I'll break it down. Let's say we have somebody that is starting their investment at the age of 20. In the first year, they invested £100. They invested £100 every single month. At the end of the year, they're going to have
1,200.
1,200, right?
Yeah.
If that 1,200 generate 10%, how much is it going to be?
120 extra. So that's going to be 1,200 plus the 120,
Yeah, plus
10% profit.
1,320.
Yeah.
Now, at the end of that first year, what they have working for them is now 1,320 instead of 1,200. You know, if they now earn around 10%, what they will earn will be on 1,320, not 1,200.
Yeah.
Compounding. It's essentially getting your interest. Some people will not like hearing the interest, especially Muslims like us. It's essentially your profit. It doesn't have to be interest.
Yeah.
Your return. So your return also working for you. That's what it means. Now, it now takes time for it to work. If all those interests are generating, they are building a snowball. By the time you do this thing for like 20 years, you're going to be amazed at how the snowball will keep on rolling. And that's the important fact. Because of that compounding, somebody that started their investment journey in their 20, if they invested from when they are 20 and they are investing £100 till they are 50. Let me see if I can pull it up. My mark is not dead. Till they are 50. Just wait. Because I hope this thing doesn't die. So that if we pull the number, people will get it.
Yeah.
Compound interest calculator. So let's say somebody invested £100, right?
Yeah.
So they
Every
invested
month.
£100, let's say at 10% annually for
30 years or 40?
let's say 30 years. So that would be when they are 50, right? So that person is going to have, I didn't put the monthly deposit. So I've done 30. Why is it looking like this? Yeah. So deposit, that person keep on depositing £100 every month. And they do it for 30 years. They do it for 30 years. So let's calculate that. So at the end of the 30 years, so that person is going to have about 83,000. So now, say somebody started in there and out of that 83,000, the accrued interest is 47,000.
Wow, that's more than half.
That's the accrued interest. Now, if somebody started, I even did, that's 5%. That's 5%. Hang on. I was thinking that money is too small.
For 10%
Yeah, because that's 30
returns
years.
yearly. Yeah.
So that should be 228,000.
Yeah.
And the accrued interest is 191,000.
Wow.
So your contribution is 36,000.
What?
Total deposit is 36,000. Now, look at somebody that started in their 30 and they are doing £200 at the same length of 20 years because they will be 50 together. If that person did it for 20 years, right? And they are doing it monthly, what's that going to be? 53,000.
For someone doing 200 monthly, that's yeah.
So for somebody that is 20 years, just doing £100 on a monthly basis, and they do that for 30 years, by the time they are 50, they have like 228,000. Now, if you take 10 years out away, and that person starts when they are 30, and they double the money, investing £200 rather than 100, by the time they are 50, they will have 153,000. That's almost 100,000 different.
Exactly.
That is the power of compounding. I hope that basic explanation explains it a bit. But it's essentially getting the return and the interest working for you. And it works like magic.
Interesting. I'm afraid we're running out of time, but I really want to touch on two things before we go. Recently, you talked about your your freedom money or your retire money, and you put it at a number. How does one arrive at the number for? Did you call it a retire money or a freedom money? So that I get the exact word you use.
You can call it freedom money.
Okay, freedom. What exactly is freedom money, and how does one arrive at a number to say, okay, this is my freedom money?
So I may not. I will just talk about it briefly. There is a rule called the 4% rule.
Mm.
So at the end of the day, what the rule tells you in a simple manner is that if you have a certain amount invested, by the time you retire, if you draw out 4% of it every single year, it should last you till you die.
Wow.
And your investment will still be okay. And you'll be drawing out 4% every year
Every year.
to live. Now, how do they come about the numbers? Essentially, you're going to accumulate all your expenses in a year. If your expenses is like £40,000 a year or £50,000 a year, you are now going to multiply that £50,000 by 25. If you multiply £50,000 by 25, the value you arrive at, that is your freedom money. That if you have that kind of money in your investment account,
You're
it will
ready to
keep working
retire.
for you. You can be drawing out 4% of it
Mm.
every single year, and
And you'll still be fine. Your investment
you'll
will
be
still be
fine, and
fine.
your investment will
You'll
still be growing, and you have something to live by. So that is essentially the rules that we use. It's 4% rule. So if you read about the 4% rule, that's the way they get the calculation. It gives you the rough estimate of it. It's called FU money. If I get this amount of money, it doesn't mean I can stop working. I may still continue to work anytime I want. But it just means I can tell my boss that, okay, I'm not doing again. I
Yeah.
just want to do whatever I want. That's what it means. So, and
Interesting.
it gives you a way to set a goal as well. And you can
Wow.
tally your investment towards it as well and say, if I keep on investing at this so rate, when will I get to this number? Yeah. So, yeah.
Interesting conversation. Thank you very much, Uthman. Before I round up, I'd like to ask for people who pretty much have learned a lot from this conversation, but are looking for maybe more tailored guidance or would like to speak with you. Number one, do you offer any kind of paid services to sort of advise people? I know you're not a financial expert, and you probably you always say this, put this out there as a disclaimer, say these are not financial advices, but you do give out very solid and very, very good information and advice. Do you often take people reaching out to you, provide advice to them about financials, maybe how to get out of debt? Some people are drowning in debt and looking for someone to speak to help them come up with a strategy how they would clear their debt. Just someone wanting to get general financial advice. Is this something you offer? And if it is, how does one reach out to you? How do they contact you to?
Okay.
Um,
So, first off, I will first clarify the fact that I do not have any group. It now depends on whoever reach out to me and I assess their situation, and I'm like, okay, this is the person I want to have conversation with. If I think this is the person I want to have conversation with, I can have one-to-one with that person. Of course, it will be paid. So, but other than that, I don't have any mentorship group or
no
whatever.
Telegram group,
Yeah, no,
no.
I don't have any Telegram or anything. I just don't have the time for it. I would really love, people are just suggesting have a community, but I don't think I have the time to manage a community now.
Mm.
But depending on tailored individual, if I see an individual I can work with, I can have a one-to-one with the person. And they can reach out to me on socials. TikTok is out of it. Please don't reach out to me on TikTok. I have a lot of followers on TikTok, but there are so many cloned accounts on TikTok. You may not even know, and you reach out to somebody
The
that's
wrong
going to
one.
scam you. But I think Instagram and Twitter are still kind of okay. So you can reach out to me on both. I'm verified on both. Even on Facebook, I'm verified. It's only TikTok I'm not verified. And don't reach out to me there, please. So you can reach out to me on Twitter. You can reach out to me on Instagram. The name is Nurse Investor in all of those places. So those are where they can find me.
Interesting. You've got very, very good advice, my friend. Thank you very much for your time today. Really enjoyed this session. I think we definitely need to have a part two of this because I still have some questions that I jotted down and we can't cover. I promise this wasn't going to go past 1 hour and it's already over an hour, 16 minutes. I really appreciate your time. Thank you very much. If you've enjoyed this episode, as always, please use the like and the subscribe button and get more insightful content coming out of the podcast. Thank you very much, everyone, for your time. I appreciate it. And I hope to see you in our next video. Cheers. Bye for now.